exactly what is going into the bill and what those outcomes might look like.
One of the best things that people say to me is you make it fun, if that can happen, and you make it understandable.
What the impacts are going to be, not only for our clients, but for anybody listening that's not a client, and just getting a sense for how we would think about the implementation of some changes that would come to anybody's tax picture. So
welcome to the podcast, Retirement Done Right, hosted by David Rath and Pat Kalish. We tackle various topics such as retirement, Social Security, taxes, estate planning, wealth planning, and more. If you have further questions or want to learn more, we would love to hear from you. You can reach us at contwealth.com. Please note that the information discussed on this podcast is for educational purposes only and does not constitute professional advice. Listeners should not act upon the information or content without first seeking the advice of a licensed financial professional.
Hello and welcome to, I think, what would probably be a continuation of some chatter that we had prior to the calendar flipping. We haven't come up with a nice, catchy title for this segment just yet, but I'm very happy to welcome back on our show, Sarah Dorsey, CPA. Sarah, it's always great to see you, great to talk to you. And for those who aren't clients of ours that may not have seen the announcement, you are now officially a member of Continuum. How does it feel?
Woo, feels great. Yeah. I love that we had, our meetings here and there prior to joining the Continuum group, but now to be here has just been exciting. I love that I get to see you guys weekly right now at a minimum, and that we're getting a chance to work together more continuously. And yeah, it's been great. I'm excited for little foreshadowing of the time where we can be in the same office together.
Well, we're thrilled to have you on board. It's been so far so good. We made it through a tax season, and
Yeah.
taxes are one of those issues that nobody likes to talk about. It's not fun to prepare your taxes. It's not fun to send a check to the IRS. And what is it happening right now behind the scenes in Congress might be changing some of the impact or the outlook for individuals and for business owners. And I wanted to have you on today to talk about, obviously things are going to change as they're finalized, as things become law, but we wanted to get out in front of it and discuss this bill, a big bill, a beautiful bill even, and what the impacts are going to be, not only for our clients, but for anybody listening that's not a client, and just getting a sense for how we would think about the implementation of some changes that would come to anybody's tax picture. So if you don't mind taking a second and just talking about very big picture, what are some of the things on the table in this bill?
Sure. Yeah. And I know that taxes are not a fun necessarily topic for people, but I have to say that I really do love talking tax. Um, and one of the best things that people say to me is you make it fun, if that can happen, and you make it understandable. So it's great for me to hear because that's kind of my goal in going through in this practice is opening the door to people that might not enjoy talking about it to make it more feasible and more comfortable.
If you can make taxes fun, we might have to consider a raise.
Yes, let's do it. There's my carrot, right?
Yes, absolutely. So I know there's some major things going on with the bill, and this is primarily such a big point right now because a lot of the tax changes that were implemented in the Tax Cut and Jobs Act (TCJA),
Yeah, that. Yep.
they were scheduled to sunset at the end of this year, and so
Wow.
yeah, let's talk about like the big picture stuff and exactly what is going into the bill and what those outcomes might look like.
Yeah, so the TCGA was set to sunset end of 2025. And a lot of things that happened in that were tax saving measures for taxpayers. Um, and so one of the big things that's included in this one big, beautiful bill is, I just like saying it, um, is fixing those tax rates for individuals, married or single. overall tax rates did go down for both of those subsets, and those are hopefully going to be made permanent with this one big beautiful bill. So the highest bracket is right now 37%, and if the TCGA sunsets, it goes back up to 39.6%. Um, and in general, the brackets are kind of spread out more now so that more people are being taxed at lower rates. So hopefully that will continue. I'm assuming, I think that will pass. It's already, as most people know, it's already gone through one round of review and adjustment, and that's still in this bill that's set and gone through Congress and the House at this point, up to the Senate. Um, so that's one big thing. The other thing is the estate and gift exemption amounts that are set to also a sunset right now for a married couple for federal purposes, not New York State, but for federal purposes. You can either give away or die with almost $30 million throughout the course of your lifetime. That doesn't take into account annual gifting exclusions. That's off the table for this point. But um, if that sunsets, that's going to be cut in half, basically. So the current bill is set to extend that, make that permanent, at least until we get another, administration.
As things go. And the 30 million that would be for a married couple, correct?
That's for a married couple.
Okay.
Correct. Yeah.
And you made an important distinction there too with federal versus state. And so if you do live in a state like New York, where the exemption is lower than the federal level, that still does lead to a discussion where you probably should bring in an estate attorney to talk about how do you limit your state estate tax, and the federal exemptions being what they are, if they continue at their current levels, those are some pretty big numbers, but the limits are much lower for New York State, so there are still some things to be aware of there.
Right. Absolutely. Yeah. It doesn't take estate planning off the table entirely because mm, a lot of states have a lower threshold amount for estate tax purposes. Just a quick side note, one of the beautiful things here in New York is we don't have a gift tax amount right now. So, um, a planning item really would be to use that federal gifting amount of $30 million to reduce your overall estate below the New York State estate tax threshold. So,
I was not aware of that, and so I like learning stuff as we're going through these discussions, and that's a great point. And you want to make sure that you are minimizing that tax that you pay or minimizing the amount that your estate pays. And a planning item like that can pay for itself in spades without really having to do too much from the standpoint of um, shuffling paperwork and getting stuff done. But if we can do things that are going to limit that tax bill for you and your heirs, everybody wins.
absolutely. Yes. Yep. Yeah, a lot of times I see the goal is tax reduction, but you just want to make sure that it's consistent, right, with your overall planning goals and how you transfer your wealth. But um, it's kind of I don't want to say a no-brainer, but if you can work it out so that you can still meet your goals and save some tax, why not?
Absolutely. Now, for people like myself who still have young children, and there is some discussion about the child tax credit, and also maybe some discussion about standard deduction, itemized deduction. Can you go into that a little bit?
Yeah, absolutely. So the TCGA basically doubled the standard deduction for individuals and married couples. Um, you know, prior to TCGA, I would say probably, I don't know, 70% of my clients um, itemized because of mortgage interest, state and local taxes. The TCGA really simplified things by doubling that standard deduction so that gathering paperwork was less of an issue. It was fairly simple to just take that standard deduction, and you really didn't lose a lot. Um, so that's continuing for in this big beautiful bill. That standard deduction is set to be made permanent, and also the child tax credit doubled to $2,000 with the TCGA, and so that's also set to be made permanent, with 1,000 of that being refundable. Meaning, if let's say you have a $1,000 tax bill, that child tax credit will reduce it down to 1,000. Well, it'll even a $1,000 tax bill, the child tax credit of 2,000 reduces your total tax liability to zero. That's dollar for dollar reduction, and then you still get that $1,000 refunded to you on top of having zero tax.
And it's nice because children only cost 2,000 a year, so we're basically even at the end of the year when it comes to paying for our kids.
Right, right, exactly. Yeah, so yeah, dollar for dollar on that. Um, well, you can, for whatever since you have all that extra savings, you can put it into that new Trump account.
Which I have not heard. I've only seen the headline, so that's a discussion for another day, about what that looks like. But yeah, the 529 contributions and all things being equal, more money is better to being able to put towards your kid's future. So clearly, they'd cost more than $2,000, but every dollar counts. And so I think to help families and to put some more money in parents' pockets is a good thing. I'm biased, but I think that that is at least gonna ease the burden somewhat. Are there any sort of other aspects that we should be talking about in the big picture? Of course, there's a lot of nuances in the bill, but any other big picture items?
Yes, well, I think a couple of things that I've noticed from the bill overall are two things that are being kind of um sort of like highlighted. One of it is building families, right? So by increasing that child tax credit, having these Trump accounts potentially available for young children, it seems like that is one of the items. The other highlighting item is bringing production back to the United States. We've heard that a lot from this administration. Um, so bringing businesses back to the United States. So I'm seeing from just my cursory overview of the 1,000 pages in the bill, there is a lot of focus on manufacturing, business credits, R&D credits, and then also this family and child uh, credits and advantages to kind of growing your family.
Okay. And as we've talked about, anything that helps in those areas, I think would be positive. The flip side that we won't get into today is deficit talk and all that stuff, and the other side of the equation. So I want to be focused on how this impacts individuals specifically. And
Mm.
we talk a lot here, and we've done a full podcast on this before about Roth conversions. And with the new bill potentially being passed, some of the differences in the tax brackets, would you say a Roth conversion would be more or less attractive moving forward, assuming that we pass everything in there?
Sure, yeah, I think it would be more. Uh, It'd be better to do it now. That was the word I'm trying to look for. Yeah. Yeah, absolutely. I think these lower tax brackets make it beneficial to look at those now. What you're doing is you're kind of accelerating the tax that you're going to pay to some degree. Um, you're pulling it into a period of time where you have lower tax brackets, so you're going to pay less tax now. Um, And by reducing future income, remember the Roth, you put money into it now, it grows tax free. And when you pull it out later, there's no tax on the growth. Um, Later on down the road, there's some key savings in these plans for retirees. And a lot of it is income based. So if you can reduce your income in future years, not only are you saving on potential tax rate increases, but also hopefully keeping your income at levels that are below thresholds where you might lose out on some of the tax savings for retirees or for older people.
So you can look at it as locking in some of the lower rates. Of course, it matters your own personal situation and should we or should we not. That is a discussion to be had with us and Sarah in conjunction as we're crafting these strategies for you. But all else being equal, the lower tax rate that you can pay, the better off that you are. So some of these lower potential tax brackets,
Mhm.
we want to take advantage of them. We want to have the discussion around Roth conversions and making sense for not only this year, but also future years, as you mentioned, and lowering that lifetime tax bill for our clients.
Yeah, absolutely. Of course, you hear a lot, like there's no one size fits all. Um, and the beauty, I think, of having these enacted this year is that we have 4 years to plan with people, which is fantastic. We can make some changes now, based on what we know, which is pretty amazing, or that we can do it, for more than just 1 year.
Yeah, the more runway that we have, the better. And so we're not scrambling. The other nice thing is if this passes, it's done not December 31st. And so
Right.
we can start to put our ducks in a row before the tax time comes, which is kind of crazy if you think about that. We're almost halfway through the year, right? And we already start having to think about tax. I don't want to give you any nightmares here, but we already start having to think about tax time next year and
Yeah.
that sprint to the finish that we see between January and April.
I know, it always feels like, "Oh, I have so much time," and then all of a sudden it's October and you say, "Where did the time go?" So really, yeah, this is a good time to start thinking about it, and if we can get this, if we know what's gonna happen on July 4th as they're predicting, that would be fantastic.
Yeah, more planning the better.
Absolutely. Yeah,
Is there? Oh, sorry. Go ahead. No, I was going to say if there anything for business owners, but if you have something on individuals that you wanted to talk about further, that'd be great.
sure, yeah, yeah, one quick thing, is, so with that standard deduction, being so high, the other thing I'm seeing a lot of is people aren't getting benefits from their charitable donations. So the other thing that is going to be reinstated is the ability to take a charitable deduction, even if you are just using the standard deduction. So it's not huge; it's a $300 one, but still, it's a lot of people like there a lot of people are charitably minded in general, but the fact that they can at least get some small benefit for making those, charitable donations is still, I think, incentive.
So it'd be a max deduction of $300.
Yeah.
I like how you frame that too. Is it's still something, and absolutely right. I always find it funny as this is clearly a behavioral finance thing where on a large thing like a tax bill or you know what your personal tax situation looks like. We're talking thousands of dollars of taxes owed. So,
Yeah.
oh, $300 deduction. What is that going to work out for me? 50 bucks.
Yeah.
If somebody were to walk off the street and say, "Do you want this $50?" You'd be like, "Yeah." It's still $50. It's just because it's occurring in the big picture of multiples of more than that. Then it's just whatever. It's not going to make that big of an impact. It's still $50.
Still $50, and most people, it's not really gonna necessarily change their giving. They're gonna continue the
Exactly. Yep.
giving that they're doing. Yeah.
So let's shift to businesses now. And as a business owner myself, I actually sent something to you via our internal chat about some things that could potentially be going away that are currently written into law. Do you mind going
Sure.
down that road for a second?
Yeah, yeah, absolutely. Yeah, so the biggest, I think, surprise, at least from my perspective, and I think from a lot of other people's too, is this pass-through tax deduction that may potentially be going away for some industries, not all, some industries. So just a little bit of background, this pass-through tax deduction came about after TCJA limited the state and local taxes you could deduct as an itemized deduction. So this was part of their whole simplification process in reducing, I guess, itemized deductions so that they would be similar with standard deduction. Um, but what that did was it created some loopholes for states to try and um, create avenues for taxpayers to still be able to make some of these state taxes that they're paying a deductible expense. So this pass-through deduction was enacted, a pass-through tax deduction. So what happens is each business makes an annual election, and by businesses, it's pass-through entities such as partnerships, S corps. That's really it goes to entities, LLCs, taxed as partnerships. Um, they make an election, they pay tax at the state level, and then that flows through to the individual taxpayers as a credit on their individual tax return. So up until this point, it's been available for any of those entities. So one of the items in this bill is limiting the eligibility for service businesses to no longer be able to take that deduction. So a service business would be something like an investment manager or a CPA. Um, and part of the surprise to me was that, I think this administration is pretty pro-business, so I was surprised that it happened. I think it's probably coming through, um, as part of that whole, like, they're focusing more on manufacturing, entities as opposed to service-oriented entities. But I do think what'll end up happening is there'll be income limitations, and we'll still be able to make some recommendations or do some things planning wise to reduce income so that we are still able to take these deductions. So,
Just
yeah.
speculating, is that part of the concession process where, okay, we'll add this stuff in, but we have to make some concessions on this end to balance it out? Do you think that was part of that
Yeah.
process?
Totally. Absolutely. Yeah. I mean, the numbers that they're putting on where tax costs versus recouping the money from, I don't know, I think there was like $900 million is coming is it's costing for this pass-through entity tax deduction, in the budget. Um, I think one of the things that they're trying to offset it with is they did increase the pass-through entity deduction, so it's a little bit confusing because there's pass-through entity tax deduction, which is state and local taxes, and then there's this pass-through deduction, and that is also known as a QBI deduction, qualified business income. So they increased that. Before it was a 20% deduction, now it's a 30% deduction. So I think that they're trying to kinda even it out, um, in that sense by taking away maybe some of this pass-through tax and giving us a little more on their deduction.
Well, I don't have anything else on the business side of things, or is there anything that I'm missing that have you read through all 1,000 pages of the bill?
No, I read highlights of all 1,000 pages. How about
That's good enough. I wouldn't expect anything more. And it's not even passed yet. So once it passes, I will be expecting you to read all 1,000 pages.
well, yes, exactly. That would be the time to. Right.
Thing that we're missing from the business standpoint.
The other thing is really it's just they're looking to increase Section 179 expense deduction, meaning, you buy a piece of equipment, typically you write that off over 5 years, unless you make this Section 179 expense election. Um, in the, way back when I first was an accountant, it was a $250,000 annual deduction, and now it's up to over $1 million. So they're going to keep that in there. And some additional research and development credits are going to hang out. Um, and then I think they're looking also to enter into some additional employer-related credits for providing childcare for employees, opportunity zone credits for investing in areas that need some revitalization. So again, that's what where I come back to. You can see where this administration is kind of focused on. increasing some areas.
Is there anything in there for the dependent care spending account increase above $5,000?
No.
I think it's been $5,000 for the last, I don't know, 30 years.
Okay.
And
Mhm.
anybody who has kids in daycare knows it is much more than $5,000 a year, especially if you have multiples. So
Yeah.
I think, I'm not political at all, but I think an easy win would be, hey, we'll just make this tax deductible to send your kids to daycare. But I
Yeah.
don't make the decisions around here, so I will just complain until my kid is done with daycare.
You'll give a few more years.
Actually, a few more months. So Michael is done in August, and so it's public school, and I am free and clear.
That's amazing. That went by fast.
It does go by fast, as they say. Is there any?
Yeah, as they say.
So obviously, all the stuff that we talked about today is not set in stone. We won't have the details of the bill until it gets passed. We don't want to make any decisions based on what is currently in there because things can get changed around. But it is helpful to start planning based on how it's currently written because I would guess the one that eventually gets passed is going to look pretty similar to what's in there right now, so we can get a head start on beginning to plan for these types of things. But then once it is passed,
Mhm.
what are some steps that people can take or should they take once we have more clarity on that stuff?
Yeah, I mean, I think, the biggest thing is just reaching out. I think making sure that, you have an idea of where your assets are at this point um, making sure that if you wanted to work with us or if you're currently working with us, are in your loop of what you're thinking about, and then also just reaching out, set up an appointment, say, let's go over how some of this stuff is gonna change for me. If it's not something that you're interested in even, like, getting information about, but you just want us to take care of it for you, that to me is kind of like the biggest first step is reaching out.
I couldn't have said it better myself. That is something that I wish more people took advantage of. And we are here to help with
Mhm.
all of this. And it's much better, similar to not going to WebMD before you go see your doctor. It's much better to come straight to the source. As Sarah mentioned, is she's going to read through all 1,000 pages of the bill once it's finalized. So come to us with questions because it's much better to do that than get it from whatever sources that you might be able to get it online or through AI or whatever your primary method of information gathering is. Come to us, ask us questions because as we've talked about throughout this episode and on prior episodes, there's not a one size fits all answer.
Mhm.
You want to know how it relates to your personal picture. And the only way to do that is to talk to somebody who knows your personal picture. And so if you're a client, obviously come to see us first. If you're not a client, talk to us about what that looks like because we love talking about this stuff. Sarah loves talking about taxes much more than me, but we love talking about how all of this fits into the puzzle. And we want to be there to guide you so that you're not guessing. It's not guesswork to try to figure out what you should or shouldn't do with your investments, with your taxes, whatever. All that's going to be coordinated. And that's what we really do for people.
Absolutely.
I was on a roll right there. Thanks for letting me go. So to recap, I would say the biggest changes as it relates to affecting the most amount of people are going to be, correct me if I'm wrong, the tax brackets, the estate tax implications, uh, for businesses, some of that pass-through entity, and the standard deductions staying where it's at. So those are the ones that I'd say affect the most amount of people. And then obviously some other little ones in there that we can strategize around. But is there anything I missed on that recap?
Nope, got it.
Perfect. A plus for me.
Full stop.
All right. Well, as we mentioned, talk to us if you have questions, reach out to us. We like talking about this stuff. So we're happy to help in whatever way that we can. Sarah, we have to come up with a name for this segment. Maybe it's tax talk, nice alliteration.
Yeah,
Any other ideas for that?
that was my best one so far.
All right, we'll roll with that for now and make adjustments as we go. But thanks again for jumping on. It's always a pleasure to talk to you.
Same here. Thanks, David.
All right, take care.
You too.